Good morning and welcome to Business Morning. I'm Chimeze Obi Iwagu. There are still flurry of reactions trailing the decision by the Monetary Policy Committee of the Central Bank of Nigeria's decision to increase the cash reserves ratio for banks from 22.5% to 27.5%. The committee had cited the need to contain the rising inflationary pressures while also keeping system liquidity in check, though it held other policy parameters constant, with the MPR retained at 13.5%, while liquidity ratio was also left at 30%. Well, activities in the first trading day post-MPC decision have shown equities market declining on the day by 0.26%, while the fixed income market traded bearish, with average treasury bills and bond yields rising across benchmarks. Well, joining me now to discuss this is the Vice President at Investment Research, Robert Omotunde. Good morning, Robert.
Morning,
Thank you for joining us.
Yep.
Well, today is the second trading day after that historic hawkish decision to increase the CRR to 27.5%. Now, let me start by asking, was the decision envisaged by the market?
Well, I think the market largely did not envisage that the MPC was going to raise CRR by 500 basis points. There were some talks about a possible tweak in CRR, but nobody thought the MPC would move it as much as 500 basis points. And in fact, it was a little bit shocking, for some market watchers who were perhaps expecting that status quo will remain, as the committee was likely to do nothing. Perhaps those who, expected some form of changes, just expected a little tweak in the MPR, perhaps just to align with market trend. But what the committee has done effectively is to take loan-to-deposit ratio to 70%. Because if you look at it, remember that in September, the central bank came up with the banks maintaining minimum loan-to-deposit ratio of 60%. By the end of 2019, that was December, they were expected to up it to 65%. Now, you've moved CRR by 500 basis points. If the banks had maintained 65% loan-to-deposit ratio as at 31st of December 2019, a 500 basis point move in CRR effectively implies that the loan-to-deposit ratio is currently at 70%. But of course, like you said, it was historic because we've not seen that move in the past 2 to 3 years now. But the major thing to say now is you would expect that there will be some form of consistency between what the central bank is doing and what the committee is suggesting. Maybe it speaks to the independence of the Monetary Policy Committee, who is chaired by the central bank governor himself. But central bank governor or the central bank, in its wisdom, is asking the banks to create more loans in the system, but this move by the CRR already restrict their capacity to do more.
Now, the day after the MPC decision can actually be said to be quite unfavorable, particularly the equities market sentiment. Yesterday, we saw the index losing about 26 basis points. Now, is there any cause for equity investors to worry at this point?
Well, equity investors, most equity investors understand the nature of the market in the sense that it's a very volatile market. And if you look at what happened throughout 2019, by far, the market was down by over 14%, when you look at it year on year. But coming into 2020, we've seen this sort of renewed, investor optimism. But some would call it the January effect, January
But
effect.
we saw that come crashing after that.
If you look at the market over the last 3 years, we've seen the January effect play out, consistently. We saw it in 2018, we saw it in 2019. 2018 was similar to what we're experiencing now. But in 2018, before the end of January, market had gained over 17%. It was nearing 18% before we started seeing a retraction. Now we are seeing a market bull run from the first trading day. Although we are seeing some correction, year-to-date return is still at 10.1%. But the point to make here is that should we expect this rally to be sustained? Of course, one would think that the performance of the market yesterday, because that was the first trading day, like you mentioned, after the MPC decision, it would suggest as though the market is already reacting to possibility of the likely implications of the CRL move to 20 to 27.5%, because you would expect that this would impact on the capacity of the banks, to earn more income, because this is an additional fund that has been quarantined from them, which they will not earn additional interest on. So it was not particularly favorable, you would say, for the equities market. But whether this will be the, trend going forward, it's not particularly
All
certain.
right, let's look at this implication on the broad base, especially in the light of, you talked about the loan to deposit ratio policy
Yeah.
of the central bank. Of course, we have the build-up in domestic inflationary pressure.
So, I mean, again, you look at some of the concerns of the committee, the Monetary Policy Committee. They mentioned the fact that they needed to put a rein on the rising inflationary pressure. But the point to make here is our inflation cost push or demand push? Because what we're seeing right now is an should I say, the attendant impact of some of the macroeconomic decisions that have been made on the fiscal end. In August of 2019, there was the announcement for the closure of the border. The borders are still closed. The implication is that, we don't have free movement of goods, across our land borders. Now, this has impacted on the prices of goods, domestic goods, and when you look at the CPI basket, which is Consumer Price Index, which is the index that is used to measure inflation, it's food constitutes about 50.7% of that basket, and to that extent,
Yeah.
when you see increases in prices of goods, it is expected that it will impact on inflation. So this is not an inflationary pressure that is induced by so much
Liquidity
money or
in
so
the
much
system.
liquidity in the
Yeah.
system. It's more cost driven. So whether a monetary approach to solving a cost-induced inflationary pressure is the way to go. I mean, in the wisdom of the committee, they have decided to move in that line. But
Now,
from study, it has not shown that
Now,
Nigeria's
now, now
inflation can
some
be
people
contained by money.
see some kind of risk
Yep.
in the financial system stability.
Yep.
Do you also think so?
Well, I mean, we do not think that is a risk. You remember that the monetary policy, management, whether the MPC is making the decision or the central bank through its regulation is coming up with some policies to, address concerns within the economy. They have that mandate, but I don't see it as a risk because again, what the committee has done, when you look at the implication, it's just going to take additional approximately 299 billion away from the system. Because when you look at effective CRR before now, check data as at September, effective CRR was around 25.8%, even though the regulatory was 22.5. So taking it to 27.5% will really take an additional 299 billion away from the system, But we still have quantum of liquidity that are expected, to be injected into the system, particularly in February. The estimate is approximately 2.2 trillion or thereabout. But the portion of it that can still access the domestic treasury bills, bonds market is estimated at about 1.2 trillion. This is much of liquidity that will be expected in the system. We don't think it creates much financial system instability as much as the banks are likely to, be beaten again because more money is taken away from them that they could have used to generate more income.
Now let's look at the fixed income market. How would you describe the reaction of that market, to the quarantined liquidity in the system?
Yeah, what we saw yesterday again was a slight uptick, in yields. I think a piece we saw average treasury bills and bond yields across benchmarks, inching higher by 7 bips. And this was quite expected because, if there's an additional imposition that will take more money from the banks, it's expected that it will be taken from the system. And the fixed income market moved by the dynamics of system liquidity, the demand and the supply, So what we saw yesterday was more of, in fact, COBB and OVN rates, they went into the double-digit territory because, again, there was scarce liquidity, because of the decision. So what we'd expect going forward will be, we don't expect that the new CRR policy is going to, so to speak, have a long-lasting impact, on the fixed income market because of the liquidity injection that I mentioned. We're expecting will mature in February. 1.2 trillion is not, it's not a joke relative to the supply that we expect from the bonds and treasury bills end of the market. There's a shortfall in terms of supply relative to demand. So the overall direction of yields is still expected to be downward trending.
Okay, Robert, just before I let you go, how do you see this new move by the central bank impacting on the financial performance of the bank, particularly as we expect the first quarter earnings?
Nigerian banks have been quite resilient. If you look at the history of, the macroeconomic developments in Nigeria, especially since 2015, you're seeing that even in recession, the banks made more money. So what we'd expect is that this decision definitely will have impact in the sense that you're taking more funds from the bank. Banks are paying interest on those funds, but central bank is taking it from them at 0%. So banks will have to be much more ingenious. We expect net interest margin to contract for banks, but banks that are very active, in the fixed income space, might be able to, cushion that effect through additional trading income if they are actually very active. But in terms of net interest margin, on the average for the industry, we expect it to shrink. And this will have impact on earnings, which we then have is attendant impact on how the securities are priced on the market.
All right, thank you. Well, I guess this is a continuous conversation as we continue to digest exactly what the Monetary Policy Committee is trying to achieve with this move. Thank you for your time, Robert. Well, Robert Omotunde is an investment analyst and the Vice President at Investment Research. And talking about the increase in the CRR, we will also find out what it means for the domestic commodities market.